Okay, folks, on to Chapter 4. Chapter 4 is completing the accounting cycle. This takes us through what we've learned from chapters 1 through 3 and goes to the finish where we close out the books for the period. Now, when we close out the books, we only are going to close out what are called temporary. Your book also calls those nominal accounts. These are the ones that we want to reset every period so that we can start over. Basically, remember back to your accounting equation. Assets equals liability plus equity. No asset account ever gets closed. No liability account ever gets closed. And in equity, the capital account never gets closed. If you'll think back, remember when we branched out everything under equity from the capital account, we have withdrawals. Withdrawals is considered a temporary or nominal account. Revenues, all of our revenues are nominal or temporary, as well as our expenses. So when we go through the closing process, we're going to close out all revenues, all expenses, and all withdrawal accounts. But let's look at this worksheet that we have here. Notice the two first columns are your trial balance. These are the balances taken from your general ledger, where you go and have every account listed with the balance associated with that account. Notice that in the accounts listed, it's in the accounting equation balance. Notice we have our assets, our liabilities, our capital, our drawing, our revenue, and our expenses. You'll notice that down below that we have some information that is below there, right in here, that they should have went through and really and truly put up in to this equation for the accounts. What they did is that the insurance expense, depreciation expense for automobiles, accumulated depreciation for automobiles, depreciation expense for office equipment, accumulated depreciation for office equipment. These were all possibly non-existent accounts until the adjustments were made. Normally when you set this up, you know you're going to have some adjusting accounts and you go ahead and you plan for those beforehand. So you could have done this one of two ways, and I believe your book has it shown both ways as well. So your trial balance is taken straight off of the general ledger. Notice the next two columns are your adjustments. This is what we did in Chapter 3. Folks, if you're shaky on adjustments in Chapter 3, find time to keep reviewing back to Chapter 3. Adjustments are with us for our entire accounting career in 201 and in 202 for those of you that have to go on and take that course as well. Notice in here we have our adjustments. We did prepaid insurance, we did our supplies, we did our depreciation for automobiles and for our office equipment. Now notice when we did our trial balance, and we've seen that trial balance before, again we have to make sure debits equal credits. If our debits don't equal our credits, we cannot go any further. Once you have figured out any errors and your debits do equal your credits, it's time to do your adjustments, just like we did in Chapter 3. But in this instance, we're doing them first on the worksheet. Then we journalize them in the general journal. Okay? Again, making sure that when we've finished with our adjustments, our debits equal our credits. From there, we take our adjusted trial balance. This is the new one that we learned in Chapter 3. That is, we go through and we update the ledger with all of the adjustments that we have done. We get new balances, and then those new balances show here. So again, bringing over anything that didn't happen in the adjustments column. We have prepaid insurance, $2,400 debit. We credit it as an adjusting entry for the portion that's been used up, so that our new balance in prepaid insurance is $1,400. So we go through and we take that. Next thing is we've got to make sure our debits equal our credits. We cannot go on if our debits don't equal our credits. Once our debits do equal our credits, it's now time to split them out. Now, in your book, the last two of the 10 columns here is called your balance sheet and statement of owner's equity, because we lump on here this drawing. This drawing is this little wayward guy. What is in the statement of owner's equity? Stop and think. It is your beginning capital balance. Add to that any investments. If there was anything in this $30,000 that was an investment, we would add that. Then we would find out what our net income is from our income statement, financial statement. Add that to it and then subtract out the withdrawals. Okay, so let's look back at these last 4 columns. We have our income statement and our balance sheet and statement of owner's equity. On the income statement, what's on there? Stop and think. Those are our revenues and our expenses. So every revenue, in this case we only have one called consulting fees earned, and all of our expenses. Notice here, which they didn't draw a line on this, we add these up. Notice in this case, these two totals will never balance, never ever, unless we just break even, which would probably a 1 in a billion shot that this would happen. So these two accounts balances will never balance. Also, look over at the balance sheet statement of owner's equity. Notice that when you sum up the debits and the credits, neither one of those will balance either. Now, here's where the important part comes in. We're going to make these 4 columns balance. Notice in the income statement, our credits, our revenue account is $280,400. Notice adding up all of our expenses, we come up with $247,600. Okay, did we make more money than we had to spend out in expenses? Yes, we did. So we can look at that and say, okay, we're going to have net income. How much is the difference between $280,400 and $247,600? Okay, hopefully you found the difference between these two columns to equal 32,800. So what we're going to do is we're going to put that 32,800 on the smaller of the two sides. And again, excuse my writing. Well, that 3's not wanting to come in. All right. Notice on the balance sheet, statement of owner's equity side, take the difference between these two. Now let me redo this and see if I can get that 3 to show up a little bit better so we can definitely see what's going on here. I'll have to write a little smaller. And now my 2's disappearing. There we go. Okay, take the difference between these two. They must be the exact same difference that we found in our income statement. Okay. It must be the difference between these two of $32,800. Okay. If it's not the same, then it's time to go back through and check and double check and make sure your adjusted trial balance was added and subtracted correctly, that you put the right accounts on the income statement, and that you put the right accounts on the balance sheet and statement of owner's equity. Don't forget this withdrawals account. You'll notice that it's called drawing in this instance. Some books call it drawing, some books call it withdrawals. The book we use actually calls it withdrawals, but it's the exact same thing. Also remember, accumulated depreciation is an asset. It is actually called a contra asset, as you learned in Chapter 3, because that has a normal credit balance. It's going to go against the asset that it's attached to. So making sure that your accumulated depreciations are on the right side, you pulled over the right accounts, nothing's missing. Once we've gone through, made any changes, double checking our numbers again, we must match. Guess it helps if I write the 3 first. So we have 32,800 over here. All right, so now that is called our net income. And now we bring down, we drop down the 280,400. Adding these two numbers together, we get 28,400, and I forgot my 0 right in here. And then these now equal up to 70. Boy, this just will not write well today. 77,300 and 77,300. Once we balance, we double underline to show that we are in balance, and we call these our totals down here. So there is completing an entire worksheet, making sure again that our trial balances equal, our adjustments equal, debits and credits, our adjusted trial balance equal. We break out revenues and expenses under the income statement, the accounting equation, assets, liabilities in the capital account, plus that wayward withdrawals account under the balance sheet statement of owner's equity. Don't forget including these down here because those are contra assets. And then we get our totals. They will not match. We force them to match by taking the difference between the two columns. They must be the same. Adding it to the smaller the sides in order to force the columns 80. Get that in there. 280,400, 77,300. One little quick thing, if we're adding the amounts to the outside columns in these last four, we have net income. If we're having to add to the inside two columns, we have net loss. Just as a little quick down and dirty cheat. Hopefully that helps with the worksheet.